If your law practice receives or holds trust money, you carry one of the most serious responsibilities in professional life. You're looking after money that isn't yours. And the legal profession uniform law backs that responsibility with a clear annual obligation. Once each financial year, your trust records must be independently examined and a report lodged with your regulator. That's the external examination. It isn't optional, the deadlines are fixed, and the consequences of missing it are real. In this video, I'll explain exactly what an external examination is, who must have one, who's allowed to carry it out, what the examiner actually does, and the dates you simply cannot afford to miss. I'm from Quantum House Australia, chartered accountants, tax advisors, and approved external examiners, and this is your annual trust account obligation, explained clearly. Here's where we're going. First, what an external examination actually is, and just as importantly, what it isn't. Then, who's required to have one each year, and the one narrow exception to the rule. We'll look at who is qualified to act as your examiner, because not just anyone can sign off a trust examination. We'll walk through what the examiner actually does when they review your records and the warning signs they're trained to look for. We'll cover the deadlines, the dates that matter most, and bring the whole thing to life with a short worked example. And we'll finish with the penalties for getting it wrong, the key takeaways, and how we can help. Let's begin. So why does this matter so much? Because holding trust money is a position of profound trust. Settlement funds, deposits for property transactions, money held under a court order, prepayments for work not yet done. None of it belongs to the practice, and clients are entitled to absolute confidence that it's handled properly. The external examination is how the system delivers that confidence. Once a year, an independent qualified examiner reviews your trust records and reports to your regulator on whether you've complied with the rules. It's not a tax return or a profit audit. It's a focused annual health check on the one part of your practice where a mistake can end a career. Think of it less as red tape and more as the safeguard that protects your clients, your firm, and your right to practice. Let's define it precisely. An external examination is an independent compliance examination of a law practice's trust records, carried out under Part 4.2 of the Legal Profession Uniform Law and the Uniform General Rules. Its purpose is deliberately narrow, to give the regulator and the public confidence that trust money has been received, held, recorded, and dispersed strictly in accordance with the law. Notice what it is not. It is not an audit of your firm's profitability or its general financial position. The examiner forms an opinion on three things: whether your accounting records have been properly kept, whether there's any deficiency in the trust money, and whether you've complied with the requirements of the uniform law and the rules. And it's conducted under formal assurance standards, ASAE 3000 and 3100, which govern compliance engagements. In short, it's a rigorous, standards-based check, focused entirely on trust money. So who has to have one? The rule is in Section 155 of the Uniform Law. A law practice must, once in each financial year, have its trust records externally examined by a suitably qualified person appointed as an external examiner. That applies to any practice that received or held trust money during the year. Sole practitioners, partnerships, incorporated and unincorporated legal practices, all of them. There's just one narrow exception. If the only trust money your practice received or held during the year was what's called transit money, money simply passing through your hands very briefly, like a check received and promptly forwarded on, then your trust records for that year don't need to be externally examined. And here's a point worth stressing. Across the three uniform law jurisdictions, New South Wales, Victoria, and Western Australia, the obligation, the timing, and the standard form of report are all essentially the same. One regime, three states. Now, a critical point that catches some practices out: not just anyone can sign off a trust examination. Under Rule 64 of the Uniform General Rules, your external examiner must fall within a designated class of qualified persons. That means a member of Chartered Accountants Australia and New Zealand holding a current certificate of public practice, or a member of CPA Australia with a current public practice certificate, or a member of the Institute of Public Accountants with a current professional practice certificate, or a person registered as an auditor under the Corporations Act. But the qualification alone isn't enough. On top of it, the examiner must have completed a specific external examiner course approved by the Legal Services Council, run by the Law Society of New South Wales, the Law Institute of Victoria, or the Legal Practice Board of Western Australia. And one more rule: your examiner cannot be an associate of your practice. They must be genuinely independent. This combination, the right qualification, the approved course, and true independence, is precisely what Quandam House Australia brings to the table. So what does a good examiner actually do? It's risk-based and methodical. First, they plan the engagement, getting to understand your practice, your systems and your risks, and setting the scope in an engagement letter. Then they test compliance with the trust money rules. They review the internal controls over your trust account. They examine trust receipts and payments. They check that money was banked promptly, usually by the next business day, and that it was only ever disbursed on proper authority, supported by a proper voucher. They inspect your monthly trust reconciliations, and they confirm that you keep a separate trust ledger account for each individual client or matter. Finally, they prepare a report and a certificate in the standard form approved by your regulator, certifying your statement of trust money. One practical note: the cost of the examination is borne by the practice, and it must be paid from the firm's general account, never from the trust account itself. Part of the examiner's job is to look for trouble, the warning signs that something has gone wrong. Let me name the big ones. First, overdrawn client ledger accounts. A single client's trust balance dropping below zero, which means money was paid out that simply wasn't there for that client. Second, unexplained or unauthorised withdrawals, payments made without a proper voucher or without proper authority. Third, unreconciled differences, where the cash book, the trust ledgers and the bank statement don't agree at the end of the month, and the difference hasn't been explained. And fourth, the most serious of all, any use of trust money for the benefit of the practice. Trust money is never the firm's to use. Beyond these, examiners watch for patterns, frequent small transfers, repeatedly overdrawn accounts, inconsistent supporting documents. Most of these problems are small and innocent when they start. The examination exists to catch them while they're still small. Now to the dates, because in trust accounting the calendar is everything. In all three uniform law jurisdictions, the trust examination year ends on the 31st of March. From that date, a sequence of deadlines follows. In New South Wales, a practice that held trust money confirms its position to the Law Society shortly after year end, around the 30th of April. Then your statement of trust money and the external examiner's report are due by the 31st of May, lodged through the Law Society's online trust lodgement portal. Victoria and Western Australia follow the same 31st of March year end and 31st of May reporting rhythm through their own regulators. So the single date to circle in red is the 31st of May. That's when the examiner's report must be lodged. And here's my strongest piece of practical advice: don't leave the engagement until May. Examiners are flat out at that time of year, and a clean report depends on records that have been kept properly all year long, not reconstructed in a panic at the last minute. Let me make this real with a hypothetical example. Picture Harper and Vale, a fictional six-partner litigation firm in Sydney. For years they treated the external examination as a May formality. Records were pulled together in the final fortnight, and the examiner was handed a hurried week to sign off. One year, that approach caught up with them. When the examiner finally reviewed the reconciliations, they found a client ledger that had been quietly overdrawn for 4 months. A junior solicitor had disbursed settlement funds a day before a deposit cleared, and nobody had reconciled closely enough to notice. Because everything had been left to the last minute, there was no time to investigate calmly. The breach had to be reported, the reconciliation rebuilt, and the report lodged, all under pressure, all in the same fortnight. The following year, Harper and Vale changed their ways. They appointed their examiner early, moved to fortnightly reconciliations, and asked for an informal interim review mid-year. The next examination was clean, calm, and lodged well before the 31st of May. And the partners slept better, knowing their trust account was sound, not just hoping it was. This scenario is illustrative only, but the lesson is real for every practice. That example points to the real choice every practice faces, and it's worth making explicit. On one side is the May scramble. Records reconstructed at the last minute, the examiner rushed, no time to investigate problems calmly, and any breach reported under pressure with the clock ticking. On the other side is year-round control. The examiner appointed early, reconciliations done frequently, fortnightly is a good target, and an informal mid-year review so nothing festers. When you work that way, the annual examination stops being a source of anxiety. It simply confirms what you already know to be true, that your trust account is in good order. Same legal obligation, same examiner, same report, but a completely different experience. The difference between dread and confidence sits entirely in the discipline you keep through the year. Let's be candid about the stakes. Failing to have an examination, or lodging your report late, carries a civil penalty, and it puts your practice squarely on the regulator's radar at exactly the moment you'd rather not be there. But the obligation sits within a much bigger framework. The Uniform Law imposes strict prohibitions on the misuse of trust money, misappropriation, failing to keep proper records, unauthorised withdrawals. Where those happen, the consequences escalate quickly. Disciplinary action by the regulator, fines and the suspension, or even cancellation of a practicing certificate. And in cases involving fraud or theft, criminal prosecution. I don't say this to frighten anyone, but the vast majority of practices are diligent and honest. I say it to make the point that the external examination is the system's annual health check. It's the mechanism that catches small problems before they ever become career-ending ones. Let's bring it all together. 1. If your practice holds trust money, you need an external examination every single year. 2. It's a compliance examination of your trust records, not a financial audit of your firm. 3. Your examiner must be properly qualified, course certified, and genuinely independent of your practice. 4. The examination year ends on the 31st of March and the report must be lodged by the 31st of May. 5. Don't leave it to May. Clean, stress-free reports come from year-round discipline, not last-minute effort. And 6. Non-compliance carries penalties and the misuse of trust money is treated with the utmost seriousness. Get these right, and the annual examination becomes what it should be, a quiet, routine confirmation that you're looking after your client's money exactly as you should. This is exactly the work we do. Quantum House Australia is a firm of chartered accountants and registered auditors, qualified to act as approved external examiners of law practice trust records across the uniform law jurisdictions, but we do far more than sign a report in May. We conduct your annual external examination thoroughly and on time. We can review your trust systems and reconciliations during the year so there are no nasty surprises at year end. And we help you build that year-round discipline that turns the examination from an anxious scramble into a routine confirmation that everything is in order. So let me leave you with a simple question. Does your practice hold trust money? If the answer is yes, then you need an external examination every year. And the best time to think about it is now, well before year end, not in the rush of May. Quantum House Australia will examine your trust records thoroughly and on time, and help you stay in control all year round, so the examination is something you look forward to rather than dread. Visit quantumhouse.com.au or call our Sydney office on 1300 809 697 and ask to speak with a senior advisor about your external examination. Quantum House Australia, accountants and approved external examiners, setting a new standard. Thank you for watching.